Good day and welcome to another one of our macro overview sessions with BlackRock. Today we are very fortunate to have Ben Powell with us. Now, Ben Powell is the Chief Asia Pacific and Middle East Strategist at BlackRock, quite a mouthful, if I got that right, and is someone with extensive experience in understanding how the markets work and has promised me that he will explain all the questions I have with absolute clarity. Are we clear on that? 100%?
No problem.
Brilliant. So Ben, let's start firstly with the fact that you've been traveling extensively and have now also landed on our shores. Congratulations and very welcome. But you've also seen a lot of clients across Asia, the Middle East, Africa and the like. What are the main topics currently that are on everyone's radars?
Yeah, great to be with you, Nico. Thanks so much for having me. I'd say a couple of things, and you're right. I've been around over the last few weeks: China, Australia, New Zealand, Japan, Hong Kong, Singapore, and a few others, Oman, and so on. But Cape Town's my favorite, obviously, for you guys. So what is very consistently on people's mind, I think, is a couple of things. One is the ongoing geopolitical tension, let's say. What does that mean for markets? Is it relevant? Is it kind of just a news story, and so forth? Secondly, I think, not just in terms of markets, but the potential social implications, the everything implications of the AI mega boom. I think people are very thoughtful about that, whether it's at work, kind of thinking about what it means for portfolios, or more generally, I've got some children, what kind of labor force are they going to be matriculating into in 10 to 12 years is obviously a topic of fascination all over the world. So many things, we're trying to distill that all into what does it mean for portfolios. But again, I think that kind of geopolitical conversation, which sadly feels like it's not going away, and the AI kind of excitement / concern, like all of that mixed in together somehow, Nico, I think is kind of front and center.
So let's start exactly there with AI. It's taken over social media. I mean, in good and bad. I think we've been in equal measure enthralled as well as appalled by its rise and its dominance in terms of our everyday use. Even though we might not use it consciously, we see it everywhere at the moment when you're online. But the question for me is more, we've seen its growth, but in terms of its adoption, but to what extent is the investment case still there? I mean, a lot is hinging on AI's development and integration in everything we do, outside of just social media, right? I mean, are we going to start using it in work? But what is the investment case for AI currently?
Yeah, no, totally. So just to kind of put my cards on the table, I mean, it seems to me this is a hinge moment in human history. So I'm kind of the view that this is up there with fire, electricity. So this is not just a slightly better coffee cup. This is a big deal, I guess. Now, that's, I think, is somewhat true, but is not massively helpful in terms of what does that mean for portfolios. So let's try and take the fun out of it, Nico, and make it much more kind of pointed to your question. So what, right? So what for markets, so what for the portfolio? So if you will, come with me on a journey. We're going to start in the future and move back to the present. So we're going to start sort of, 10 to 15 years in the future. This is going to be the third stage of our journey. Again, we're going to work backwards towards the present. This is going to be societal transformation. So we're all hoping for what is in shorthand called the good outcome. So this would be massive productivity gains. The robots do all the work and we can just go surfing and enjoy poetry or whatever your kind of particular preference can be.
That's the dream, right?
That's the dream. There are other outcomes. We'll leave those hanging, I guess, but there are potential bad outcomes. But societal transformation, I think, is quite likely. But in all honesty, Nico, it's so far away. I mean, I casually said 15 years. Could it be 10? Could it be 20? Could it be 30? Sure. It's probably not 50, but it's so vague. And the range of outcomes is so wide, from the good outcome to, let's say, the bad outcome. There's always nothing sensible to say about it, coherent in terms of what do I do today in my portfolio, but very important, right? So I'm not dismissing it. It's critically important for like every aspect of humanity. So there's that. But again, we're trying to talk about portfolios and what does it mean for markets today. So that's going to be stage 3. Let's call it the long term. Medium term, coming to a theatre near you relatively soon, Nico, should be adoption. So we should see, I'm using it to try and book holidays and stuff, that's fine. But to see companies, individuals, as I say, the consumer sector, and governments, I think everyone is going to use it. We're just trying to work out exactly how to do that. And it's a bit clunky, right? So we're talking about disrupting how we run hospitals and schools. If you're a government, if you're a big business like BlackRock, it just takes a bit of time. It's probably going to come, but again, we think that'll be years, let's say 3 to 5 years. So starting to get more relevant and interesting, but still not quite today. Where we are today is in a very familiar picks and shovels CapEx mega boom. So we at BlackRock, we're kind of fully on board with the excitement around every aspect of AI, but we'd be relentlessly focused on the money. Sorry to be a bit vulgar, but I guess this is a finance podcast. But like the money, the CapEx recipients are just having a wonderful time. And just to kind of dwell on that point for a second, the CapEx recipients, what do I mean? Of course, I mean the chips, right? So the chips is kind of the most obvious central point, but it isn't just the chips. So much like me and you, Nico, you need energy. You can't just do the thinking thing. You come as a symbiotic organism. Roughly, we use about 25% of our calories for thinking. The silicon brain will use a lot, right? Seems like a lot. So the implications from AI for energy, for electricity, even all the way down to like copper wiring, we're going to need to generate a lot of electricity, and we're going to need to get it from where it is to where it's needed. That will require copper. So AI enthusiasm, focus on the money, right? The tangible stuff. And be a little bit imaginative in terms of it isn't just the chips. It's definitely the chips, right? It's definitely the chips. But it's also, as I say, things as far afield as some Korean tech companies you can think about, and even down to the level of copper wiring. So we're still there. We're still bullish. We worry it's kind of underhyped, actually. But coming down to the level of portfolios, stay long AI, but try and be a bit thoughtful about exactly what that means in terms of different geographies and even different asset classes.
Excellent, thanks. So if we can perhaps turn to the US, which, much like its president, has hogged the limelight again for much of this year. Now, its government has been in shutdown, and actually there remains surprisingly little clarity in terms of what this means for either for US federal workers, but also for investors more broadly. How do you see this play out? I mean, are investors concerned? Should we be concerned, or should we just say this is political brinkmanship that will play out the way it plays out and there will be no bearing on investors? Or are investors, especially non-US investors, starting to look at the US and go, there's cracks appearing, and perhaps we should reassess our view of the US?
I think we definitely care. And where we specifically care is it's hard to know what's going on if there's no data. So this is actually a serious problem. Is the shutdown of the US government has many implications. Prospectively, people can lose their jobs. So there are more significant, more important real-world implications. But for us, trying to understand what's going on in the US economy, that's difficult if there's no data or much less high-quality data coming through. So that's true for us. It's also true for the Federal Reserve. So the Federal Reserve is trying to navigate a very kind of difficult set of policy circumstances. Roughly said, employment's a bit weak, so that would imply they should do some cutting, but inflation's much too high, which implies they should do not so much cutting. So they're in a very delicate position, and they really need good data to try and calibrate what they should be doing from here, and they don't have any. So that's a kind of a very big problem, I think, for investors. With that being said, it doesn't seem to impact the big AI companies who, for now, in a sort of worrying way, very concentrated market, these big few companies continue to make lots of money. So that is not impacting the US equity story, at least for now. So we continue to be bullish. And if I may say so, I don't want to say it's irrelevant. It isn't irrelevant, but it is not impacting the ability of, in particular, these big tech companies to make incrementally large fortunes every quarter, it would appear. Where we do worry a little bit is on the fixed income side. So I think what we've seen over the last couple or 3 years in particular, Nico, is a concern from global markets, global investors, that maybe the US Treasury isn't quite as safe as it used to be. Still pretty safe, but it's not quite as safe as it used to be for a couple of reasons, but most obviously because there's lots of debt. Deficits are still very much in fashion. I think both political parties are kind of keen to keep the good times rolling, which makes political sense, obviously. But that's a bit concerning for fixed income investors, which is to say there's lots of bonds coming and we'll have to kind of absorb them. So an uncertainty around the data is very uncertain in the macro environment. That injects even more uncertainty, we think, specifically into the fixed income space. So some concerns there, but on the equity side, they keep on trucking.
Yeah, and if we can stay on the US, so the dollar has been on the back foot for most of the year, which very few saw coming at the end of last year. In fact, most analysts and economists predicted that should the Trump administration come to power, there's going to be a lot of emphasis on tariffs and the like, spending pressures, and that will likely drive up inflation, which will cause the Federal Reserve to react with higher interest rates. And in all, that should be good for the dollar, right? Make it more attractive. But to your point, when you start to question the Federal Reserve or treasuries more broadly, then the attractiveness of that dollar proposition, even if you earn higher yields on the margin, becomes less attractive. And so the interesting thing is the dollar's weakness is not, we didn't see that coming, right? And so despite inflation largely remaining at bay, I think the dollar has been on the back foot and continues to look like it might be on the back foot still. Do you see it the same way? I mean, or especially considering that global foreign reserves in dollars have hit its lowest level in 30 years. So clearly, there's been a lot of offloading of dollars in terms of reserves. And so do you see this changing anytime soon, or should we be defensively positioned to the dollar for the remainder of this year heading into next?
So a lot there. So just a couple of points I would make. Firstly, to reassure American viewers here, we still think America is something like exceptional. So they still have an extraordinary ability and a scale to both imagine, create, and finance the future. So it's no huge surprise. You can go back to the Manhattan Project. Basically, since then, a lot of the good stuff, the silicon chip, the internet, and now AI, have approximately, I mean, there's been many people who've contributed, let's be clear, but in the round, they've kind of been created and realized disproportionately in the US of A, and we think that that's going to continue. Now, with that being said, you can believe America is still kind of great and exceptional, but you could also have a very normal conversation about diversification. So to sound like my grandmother, you don't want to have all of your eggs in one basket, even if it's a beautiful basket, right? So diversification, I think, is a very, very reasonable thought, as ever in kind of markets and portfolio conversations such as the one we're having here, Nico. And we at BlackRock, the world's largest investor, we're having some version of that conversation all over the world with clients of every type imaginable, I think it's fair to say. To your point on treasuries, yeah, look, I think there is a little bit of a problem that markets are concerned, as are we, frankly, that they don't quite do what they used to. So in the good old days, we had a 40-year bond bull market, and treasuries were just great. They paid you an income, in the old days, 5, 6, 7%, and they really worked very well in terms of giving you resilience and ballast and kind of diversification within let's say, an equity bond portfolio. Now that's, I'm not going to say it's over, it's not over, but it's less obvious. And I think what that's leading to is a bit of an urgency. Okay, I'm a bit less certain about the US Treasury. What do I do? And I think you can take that thought in many different directions. Emerging markets come to mind, gold comes to mind. Lots of things come to mind as people try and think about diversifying a little bit away from the US from a kind of very normal diversification, too many eggs in one basket perspective, and then a specific concern about treasuries, which I think is, I don't want to draw a straight line between that and gold to $4,000, but I think there is a kind of association there which kind of makes sense to me, actually.
Absolutely agree. And if we can maybe take it back to your home country, you had Liz Truss that effectively was ousted on the back of bond markets popping, right? And so an underappreciation for the pressure that can exude on any administration. To what extent do you think, if this pressure continues that you're mentioning, and if demand is insufficient to absorb the amount of issuance of debt, I think, stand to be correct, but about 5% of US spending goes into servicing its debt cost at the moment. I mean, it's historically high levels. So can it reach a point where trust, or at least some form of deficit in trust, can lead to higher interest rates, and that can ultimately challenge the Trump administration, who up to this point has not had many political pushback, either internally or externally? And can the bond markets effectively act as that vigilante towards Trump?
They can, and they have actually. So it does seem that the US administration, who are obviously very enthusiastic in terms of their policy agenda, they do have some constraints. And one of those, I think, we learned back in April, the Liberation Day kind of wobbles. It seems to me that as soon as the bond market started to sell off, which means yields are going up, Secretary Bessent was sent out pretty quickly to reassure the bond market, investors more generally, that they understand that they need to be careful here. So I think that was pretty good evidence. And by the way, I think that's been a key reason why markets have done very well over the last several months, is an understanding that the US policymakers, they might be, as I say, enthusiastic, but they recognize that there are constraints. To the kind of deeper element of your question, That's happening to some degree. So investors are increasingly nervous about lending money to the US government, in particular for longer duration. So, the longer you lend somebody money, the more that can go wrong, just because there's more time where bad things can happen, be that inflation prints or policy surprises or anything else. So that kind of extra compensation we as investors demand for lending your money for a bit longer is called term premium. And what we've seen over the last couple of years is term premium has gone up from historically extremely low levels to something a bit more normal. And we think that's absolutely going to continue for a few of the reasons we've touched on. Policy uncertainty, inflation uncertainty, even data uncertainty, and political uncertainty, let's say, in and around that. So finally, to come to an answer, yes, we think that over time, this is not a forecast for the next week or two, but structurally over time, we rather think the US 10-year yield is likely to head up rather than down over time.
Right. I like the fact that you labeled the Trump administration as enthusiastic. There's many ways to describe it, but let's stick to enthusiastically bent on renegotiating trade agreements. Now, on this topic, so inflation has remained surprisingly muted, despite the Trump administration's push to use tariffs as a means of resetting global trade, primarily to a US first agenda. Now, what's surprising is that the expected natural pass-through of higher tariffs to higher prices has been missing. And I wonder to what extent, and there's a lot of speculation why that is the case, right? It could just be that we misunderstood that link will kind of in the short term translate, and that there needs to be a longer term consistency of higher tariffs. But also a lot of people are pointing to the 5th of November as a key date on the calendar where the US Supreme Court will meet and will effectively decide whether the US president's use of emergency powers to enact effectively unilaterally tariffs, whether that's legal or not. Now, should they find in favor of the administration, of course that means tariffs are there to stay, but should they find that it's not legal, then of course they will have to pay back those tariffs. And some are speculating that businesses in the US have not passed through those tariff costs onto prices, particularly because they don't want to lose market share, and that they believe that the tariffs are effectively transitory, that it won't stand legally to be the case. Now, I know you're not a legal expert, so I don't want you to weigh in on whether you believe the probability of that is the case or not, but could that be an explanation for why we're not seeing inflation in the US? Because it might seem that our conclusion could be, higher tariffs does not lead to inflation. And so we learn bad lessons from an outcome that's actually effectively the market is possibly betting on it not being legal and so being short term. Yeah,
a couple of things here. So firstly, good job, everybody. The global trading system has flexed pretty well, actually. So you've seen various kind of trade reroute to try and work in and around these kind of new trade and tariff realities. Secondly, energy prices have been very, very well behaved. Oil prices approximately have gone down over the last several quarters, which is, I guess, useful in kind of diminishing some of the inflationary context. But with all that being said, inflation in the US is still a little bit high, actually. So it's in round numbers, let's say 3%. So our observation is that inflation at 3% is meaningfully above their mandate, right? So the mandates, dual mandates, worry about growth on the one hand, but also worry about inflation and try and get inflation to 2%. So, I'm not a math PhD, but 3 seems higher than 2. And that is prospectively, to your point, Nico, before maybe some of the implications of the tariffs work their way through the system. Because obviously it takes time. It isn't just the US president kind of clicks his fingers or sends a tweet out and immediately that works through. It takes a significant portion of time. So I think, and to be fair, I think we have been surprised that it's taken as long as it has, but I wouldn't confuse not yet with never, right? So it still feels like there's a risk of more tariff price increases coming through into an inflation environment which is already, again, in round numbers, 3%. And that, I think, is potentially problematic for the Fed. So the market is quite hopeful in terms of the scale of cutting that the Fed can do over the next 12 to 18 months. I have to say, we at BlackRock think that that's going to be hard to deliver, given inflation is already too high. And at least in at least the way we tell the story, that's before some of the consequences of these tariffs kind of work their way through. So we worry the Fed is going to be unable to deliver as many cuts as many are hoping for because inflation's too high.
So if we can conclude that inflation or that tariff pressures might be transitory, it might be permanent, would you regard Federal Reserve independence as transitory or permanent? I mean, to what extent? Because a lot of what you're saying hinges on the Fed being able to operate independently. Perhaps raise rates should it be required. But we know there's been a lot of political pressure exerted on the Federal Reserve. To what extent can they remain independent?
I think it's likely the independence of the Fed persists. It is something of a crown jewel in U.S. exceptionalism. I think senior leaders in America are extremely aware of that. So I would think, as a matter of kind of practical mechanics, the Fed will remain independent. Now, with that being said, it is true that the Fed's independent, as are many central banks, but it's also true that the people who run the Fed are appointed by political authorities. So Fed independence is true, asterisk see Appendix 1, but they're appointed by politicians, including my namesake, no relation. Chair Powell was a Trump appointee. So it's completely normal, actually, that politicians will appoint Supreme Court justices or Federal Reserve governors, very, very important people. And I think, to be fair to President Trump and the US administration, if you look at his track record, particularly into independent bodies like the Supreme Court and like the Federal Reserve, I don't want to get too far over my skis here, and I don't have any opinions on any of them as individuals. But speaking to experts, there's a sense that all of them actually have been quite reasonable picks. Right? You might have a political preference here or there, that's fine. But within the kind of normal scope of a somewhat right-of-center Republican Party, the picks that Trump has made in his first term and in his second term so far have been perhaps surprisingly normal. And when we look at the list of candidates that are being talked about in the press and discussed fairly openly amongst senior leaders in the US, again, all of them, you can have a preference, that's absolutely fine, but none of them seem like they are unworthy to hold the office, actually. So, we're very interested to see what happens come the likely change at the helm, but it does seem likely to us that somebody very competent and experienced and fit for the job will be appointed. And once that is done, they will run Fed policy on the basis of the economic data as they understand it.
That's great. If we can turn to a interesting asset class that has been gaining a lot of attention, and that is gold. It's particularly for South Africa. We're a big gold miner. It's close to our own fortunes, but gold has been about as profitable as it has been unproductive in client portfolios. I mean, it's trading at historic levels, notwithstanding yesterday's quick cutback. It's still trading at historically high levels, which is puzzling to an extent, right? Because we've seen dollar weakness, we've seen interest rates being higher to what you mentioned earlier, yet the gold shine has continued. And typically that tends to be sort of your doomsday trade, right? So if equity markets are struggling or there's other reasons to buy it. Now, to what extent do you think this run in gold might be sustainable, whether it can actually continue to go up? Or has gold been mostly a recipient of a debasement trade? Right, where investors move away from sovereign bond instruments to actual real assets like gold. And we've seen Japan and China and the like have actually increased their gold reserve levels, I think, to historic highs. And I mean, that surely creates demand, but up to a point, right? And so I've heard gold described as a pet rock that just sits in your portfolio. I've heard it described as the ultimate bearish call because you're betting that, again, a rock will be more productive than the combined efforts of mankind. And so why would anyone be investing in equities, in gold versus equities at this moment? Or do you think it's, again, to your grandmother's analogy, a good diversifier? And is it in your portfolio currently?
So I think it's right to worry about inflation. So that's a kind of core premise we have at BlackRock, that inflation, unfortunately, is going to hang around, driven by very significant changes to the global economy, Chinese demographics, the low-carbon transition, and the trade tensions, which involve very likely not just tariffs, but rewiring of supply chains, where we take kind of the production of stuff away from cheap kind of areas to people we like, or even bringing it home. That's fine, but you're going to have to pay for that, I would have thought. So all of these aggregate into why we think inflation is going to hang around, and therefore, within the portfolio context, kind of expressing that concern in a diversified way, meaning worrying about inflation, having inflation hedges, having a range of assets in the portfolio that can be somewhat resilient to what is often called the thief in the night, right? So inflation is a very pernicious, inconvenient reality whereby you don't realize you're getting poorer until you go and buy your next massively inflated coffee cup or whatever it might be, and you realize, goodness, this money doesn't go as far as it used to. So that's inflation, and it's potentially more than a problem, right? It can remove trust in one's currency and so forth. Anyhow, so when I look at gold, two things. One, yep, it makes sense as part of that list. I wouldn't want to have too much, but is it on the menu of things which tend to do quite well when we humanity are somewhat concerned about inflation? It does. So fair enough, I think gold reasonably can be part of the I'm worried about inflation conversation. So can real estate, so can equities, so can so-called inflation-protected securities, so can infrastructure assets. So there are many ways to kind of express that thought, maybe even crypto, by the way. But I think gold, to be fair, has done a pretty good job. Whenever that conversation's become live over the last 6 millennia or so, gold has kind of played a useful role in portfolios, and I think that's likely to continue. Second thing is, I'm also interested, like, what is the message of gold? Like, what is it telling us to see, such a raging bull market in what you unkindly call an unproductive asset, right? So what is going on there? And I do think like there is information in such an interesting price move, and I think it is signaling some concern that there's an awful lot of developed market debt. There still seems to be an awful lot of appetite for big deficits, and maybe that's concerning. And we think that's right, by the way. So having assets that, again, can speak to that kind of worry, even if they're only a small part of your portfolio, I think is reasonable, and I think will continue to be reasonable going forward.
So I think the attractive attribute there is scarcity, right? And its unproductive nature simply is, it is unproductive, right? It just sits there. It can be profitable, but it is unproductive. But its scarcity is attractive, and I would take your point there.
A bit. I mean, I go to India quite often, and there, I don't want to pretend I'm an expert on Indian social norms, but gold plays an important part in and around various ceremonies. So, we don't want to get highfalutin, but it does play some purposes. I'm not, I've got a wedding ring, but other than that, I'm not a massive bling guy, which may surprise you, but I can see that it plays, obviously, jewelry kind of needs. And then there are certain countries in the world where it is somehow part of the social fabric. And whether that's productive or not, I don't know, but it's a fact, I think, something like a fact. So just thinking, just gently pushing back there a little bit, yeah.
Right. If we can turn to emerging markets. So China has made a very strong equity market comeback after struggling for a few years. India, that you mentioned just now, has struggled over the last year. And do you think there's any attractive valuations in EM currently from your current vantage point?
We do, yeah. So I think a couple of things. Firstly, to come to the fixed income element of our conversation, if you're a bit nervous about US yields, as I say we are, then you might want to be diversifying gold we mentioned, but including into certain emerging market bonds. So you want to be careful. Not all emerging markets are the same, but at the risk of being friendly here, when I look at South Africa, quite high yield, some improvement in the signs of the economy, power availability doing a bit better, all of the stuff everyone here knows better than I do, but that looks like it's a real thing. So if I'm a global investor looking to pick up a real yield, South Africa could be on my shopping list. And there are other examples of that within emerging markets, not all of them, but a kind of careful, thoughtful approach, I think can reap some income across the emerging market perspective. To the equities point you're making, yeah, look, China's done pretty well, so's Korea, so's Taiwan, because they are absolutely central to the AI mega boom. So I think, again, we need to be a bit careful. America is completely central, but it isn't the only game in town. And I suppose if we're to come into this year very much focused on what do we really believe? We believe in AI, then having seen the China tech sector in particular do well is not that surprising. China back in February, the so-called DeepSeek moment, I think reminded everyone, if you've got 1.4 billion people, some of them are pretty clever. Right, so that seems a reasonable bit of maths, I think, right? So those clever people, backed by the heft of the kind of political apparatus, obviously AI is a geopolitical kind of thing, and some pretty good companies, right? Some of the companies over there, they're tech companies, can hold a candle to anyone in terms of the R&D they can put through. So somehow we forgot that coming into the year, and I think through 2025 we've been reminded of that, and I think that's going to continue. India over the last 5 years has still performed pretty well. You're right, the last 6 to 9 months has been a little bit dull. I'm still pretty optimistic, I've got to say. So the demographic story is well understood. It's true. There are lots of young people in India, and assuming the country can continue to do a pretty good job of harnessing them and making them productive workers, that's a good thing. So that's like true and important. But I still think many foreigners who don't go to India often, they don't understand what's happened over the last 10 years in particular, whereby India has become one of the most sophisticated, digitalized economies on God's green earth. It isn't just like quite good for an emerging market. No. It's absolutely fantastic in terms of whether it's trading stocks or digitalization of really everything. So I still think the underappreciated story, if we think about economics as being GDP is labor force times productivity. I think people kind of get the labor force story, and that's like true and important. I'm not dismissing it, but I think people get that. I still think the underappreciation is on the productivity side, where India has done and continues to do a great job at becoming more efficient, harmonizing tax rates across a big kind of busy, noisy country, and technology moving from the periphery to a degree to absolutely central. When I go there, I'm still shocked. I go there, relatively frequently, and I'm still kind of blown away when I go through. It feels like India on the technology side has advanced like 50 years in the last 5 to 10 years. So that story I still think has got a lot of room to run. And by the way, I think a lot of countries could learn from the sophistication of India's digitalization, including in the financial market ecosystem.
That's very, very interesting points. And I think one needs to keep in mind as well, India has the numbers. To your point, there's a lot of Chinese, 1.4 billion people. A lot of them are going to be smart and develop fascinating technologies, similar with India. And they are pushing the most graduates into the market of any country in the world. So
totally. And some of them go on to run Google. So, you can look at this astonishing Indian competence. Seemingly, again, lots of people, some of them are brilliant. Education seems very good. And it isn't just in India. A lot of it obviously is in India. But if you look across some of the best companies in the world, if I remember rightly, the gentleman who runs Google Alphabet was born in Tamil Nadu, I think, if I get it right. So there seems to be something in the water, and at least some of that is being applied now domestically to the benefit of some companies and hopefully Indian society more broadly.
So if we can also turn to Europe, it's an interesting proposition, right? So there's an ongoing war in its periphery. Several economies are struggling politically, fiscally. Are there opportunities outweighing the risks, or are you on the sideline when it comes to Europe?
No, there's always opportunities, right? The joy of investing is there's always opportunities. So the problem with talking about Europe, which I will do, Nico, so I'll come to your question shortly, but we can just buy individual companies, right? Some of them are very, very good global leading companies that kind of just happen to be listed in Europe. So I think the dream is, whether it's the UK or the EU bloc, let's call it, if you can get some great companies that are trading on a bit of a discount because they happen to be listed in a, let's say, complicated neighborhood, that's called opportunity. So absolutely, we're sort of maximally interested, but I would say it does feel like a market where you want to be quite active and very much picking your spots, even your individual securities, to try to benefit from that potentially quite interesting. As I say, they're trading in the kind of negative news flow, but in fact, they're just great companies geared into whether it's AI or some other kind of global tailwind, which is ongoing. To the kind of political context that you're speaking to, it continues to be very complicated, right? So I think that is true, and we should fess up to that, Nico. Now, with that being said, it is also true, perhaps as a consequence of that you're seeing the big economy, Germany, which has got an extraordinarily strong balance sheet, start to carefully, they're not going too crazy, but a little bit in terms of trying to provide a bit more fiscal support, be that particularly into their defense industry, because it is a difficult neighborhood, that's for sure, and just more generally, a somewhat more pro-growth fiscal stance, I think is kind of a big deal. So Europe for sure is complicated, but the joy of investing is there's always opportunities at the right price. So that's obviously what we're continuing to scour Europe for.
And then, of course, Japan. In your most recent market outlook, you suggested an overweight to Japan. What would be the rationale there?
Japan's great. So it's a super fun place to go, by the way, but that's not relevant to your question. What is relevant, I think it's like pretty straightforward, actually. So two things. One is nominal GDP. So nominal GDP in Japanese currency terms, yen terms, was basically a flat line for 30 years. I mean, that's a tough business to be in. Whatever you're trying to sell, deflation, you've got to cut your price every year. That's just hard work. Now, nominal GDP is going up and to the right. So this is not the most profound insight I think I've ever had, but it's true, and it is just a total, this is a word that's overused in kind of financial podcasts, but I think it is a revolution, right? Flat for 30 years, and now up a lot. It is a big difference, and something that should provide a tailwind, in particular for Japanese equities. That's, I think that's like, you can really see that. The one that's a little bit more subtle is the corporate governance reform story, which sounds super dull, but is awesome, in fact, Nico. So what they are doing, the Japanese are doing, is strongly encouraging, really strongly encouraging, in an almost shocking extent in a Japanese kind of very calm and inclusive kind of culture. They're really shaking things up by creating demands on their companies to do better by shareholders and naming and shaming those who are not doing it, which is, again, in a Japanese context is almost unbelievable, but is in fact happening and is driving somewhat better behavior from Japanese companies. So that's why you're seeing, by Japanese standards, a dramatic increase in buybacks. I guess that's the easiest way to seem to be doing better by shareholders, give them more money. And you're seeing the unwind of cross-shareholding. So in the old days, we you know, if you and I were running different Japanese companies, maybe you'd own 20% of my company, I'd own 20% of your company. We'd go to the golf club and agree that we're fine, right? And not allow too much kind of capitalist activism to come through. That's really changing quite quickly. So the unwinding of shareholdings from kind of people with similar interests, let's say, opening that up to like real investors, including rapacious foreign capitalists, like that's happening. So, you know, it takes time. You can't just change your entire equity market and corporate culture in a few quarters, but it's really happening. So that's more slow burn and is perhaps less obvious than the nominal GDP boom, but I think it's very, very important. And again, this isn't just me talking. You can see it in the data, the buybacks and so forth, the unwind across shareholdings. These are really happening, and that continues to make us quite enthusiastic for Japanese equities.
Those are fascinating insights. You heard it here first. Japan's back, right? After 30 years in a slumber, we are hoping that the northeast trajectory of growth is going to continue, right?
That's right. No, that's right. So you're exactly right. They've had a tough 30 years. So, you know, I was there recently and I do this weird wrestling thing called jiu-jitsu. So I went to a local jiu-jitsu club there and like, obviously very respect-based culture. So they apologized. They'd had to put their first price increase through for like 30 years. Wow. So it's just like has not been a thing in any walk of life, right? Whatever you do, and it's now a thing. And, you know, inflation, you've got to be careful. It's a double-edged sword. But if you're selling stuff, being able to put your price up and making a little bit more money is probably a good thing overall.
And that's perhaps something that our listeners should keep in mind of, is that while inflation is painful, deflation is the devil, right? Because that removes any need for you to be productive with assets. And so you can park your money in the fridge or under the bed and it will be productive. Whereas in an inflationary environment, you actually need to be productive with your assets. And so what Japan has lacked for these 3 decades is that inflationary pressure for you to be productive, to invest in companies that promise performance higher than what cash can earn under your bed.
I think that's right. And to throw another kind of stick onto this fire, the banking, we've run such an interesting experiment over the last 20 years, right? So just looking at it as a quasi-scientist, or at least somebody who's interested in economics, like what happens if you cut interest rates to zero? So like 30 years ago, we didn't really know the answer to that. And now we've got some pretty good data. And there's a few things that happen, but one of which is being a bank is pretty hard. So if you're making no money on your lending, why would you do any lending? Right, so if interest rates, you can think of interest rates as something like the cost of money. It's not quite right, but let's say that that's right.
So if the cost of money,
if the cost of money falls to zero, then that's about tough business to be in. So weirdly, increasing interest rates actually might entice banks to do a bit more lending, and that could actually be a positive in terms of credit growth into the system. So I don't know if I want to go too far and say that's definitely happening, but there's a chance that Japan very carefully and slowly normalizing the interest rate actually might create a positive response from the banking system, because finally, after 30 years of hurt, they can start to make a little bit of money on their lending franchise. So yeah, it has many implications, some of which are not obvious, but I do think having a little bit of inflation, not too much, but a little bit of inflation is probably a better situation than zero or negative, which is tough sledding.
Brilliant insights. I'm conscious of us running out of time very quick, fast as we sit here, but I'm going to give you a quick fire round where I suggest a term or an asset class, and you have to give us a long, short, or neutral verdict at the onset, and then a quick 5 cent if you have spare change on the topic that remains.
7 cents. 7 cent answer. You're going to get
maybe a 7.5 cent. Okay, so first term tokenization.
Long 5 cents. I think it is going to be very important in our jobs, understanding financial markets, but also for, if I can say, normal investors to get exposure to almost any financial risk or opportunity. I think tokenization, which we've sort of been a part of, so this isn't quite right, but ETFs, exchange-traded funds, are kind of a tokenized way to buy into US equities or emerging market equities, wherever it might be. I think the thought there is valid and is going to be grown to cover almost anything, I think, in the years and decades ahead. Again, this will take some time, a regulatory framework, but long. Sorry, that was a lot more than 5 cents, but you got me with the one I think is like a very big deal.
Brilliant.
I think it's going to be significant.
Crypto ETFs?
Not my speciality, but I guess as a matter of fact, we have a Bitcoin ETF, which I think has gone through $100 billion, so it seems like people are interested. So it feels like, and I know people have got strong opinions, some very positive, some very negative. I'm a much more boring Englishman, I guess, so I just try and observe the world as it is rather than the world that I might prefer. And it would seem that this is here to stay. Again, intellectually, you can have views on that. That's fine. We do that. But as a matter of fact, to go from nothing to over $100 billion pretty quickly probably tells you something's there.
AM ETFs?
I didn't get it.
AM ETFs, actively managed ETFs?
Oh, sorry. Yeah. So again, this kind of new wrapper, I think, is going to become increasingly normal. I mean, I think of our role at BlackRock is to provide choice, right? So both in terms of like what you're investing in, but also how you invest. And we want to be the best at that. And that would include, I think, ongoing pursuits of active ETFs and many other things, because for better or worse, we're the biggest. So hopefully we can provide the most choice. That's what we're trying to do at least.
ESG and sustainable investing going forward?
So we, at the BlackRock Investment Institute...
So long, short, neutral, or...?
Long. Sorry, I beg your pardon.
No.
Long. So the reason for that is we at the BlackRock Investment Institute, we have the awesome responsibility to create what are called the capital market assumptions. Don't worry, I won't drone on here too much. But that's the core IP as to how, intellectual property, as to how we think different asset classes and geographies are going to perform over time. So that's like the secret sauce, like right in the middle from which, and we treat this risk as an investment risk. So it's part of our process. We don't kind of add it on later. You know, of course, it seems to us fairly obvious when we think about sustainability. Again, you can agree or disagree, that's fine. But trillions of dollars are flowing into different parts of this kind of, let's call it theme, which are going to drive returns, some positive, some negative. That, to us, that just seems like a fact. Well, not seems, it is a fact. So again, we have a very pragmatic approach to trying to deliver for our fiduciary responsibilities. Of course, I hope that's a given. And some of these risks, which were somehow previously bucketed as kind of their own thing, we entrench into our portfolio construction as important as inflation or trade tariffs or anything else. It's a risk.
Tariffs.
I think they're going to continue. So I'll say long, having hedged a bit in what I mean by long. So I think, this is going to run and run. It feels like the US administration is really enjoying them. So he's using them, obviously, I say obviously, it seems to me, not just to raise money, which they're enjoying, but also to encourage partners all over the world to kind of fall into line. If President Trump were on the line, maybe he's watching, he would claim that they've been used to solve 8 wars. So I don't know about that.
Right.
But I think his enthusiasm around them goes beyond just the money. He's fine with the money. But he feels that it's a tool for global harmony, American hegemony, and the betterment of humanity. So I think if that's the view, and that's what I think he thinks, probably here to stay.
So if Trump's the tit, who's the tat? Is the tat going to come?
How do you mean? Sorry, I don't quite...
So if he imposed tariffs, is there going to be reciprocation
sorry.
at all?
Yes, there is. And we're seeing this like right now. So we're, all being well, we'll have a meeting of the presidents towards the end of next week. President Xi and President Trump, prospectively, will meet in Korea in a few days' time. And the way I think about the US and China is there's absolutely a dynamic negotiation which is going on, and that's happening in real time. But the way I think about it, it's like seeing a married couple bicker in public. So it's a bit embarrassing and we all feel a bit awkward because it's playing out on social media, whereas for most of the last several thousand years, it would have happened in rooms with the doors closed, right? So that's a bit different. It's going to continue, but they're married. So I think there is going to be some back and forth. We're seeing that, and that's going to continue. But where we have some comfort, and I think where the market has drawn some comfort, is they're stuck with each other. The mutual interconnection is so deep. The whole idea of decoupling for us doesn't really make sense because they're too married, if that expression makes any sense. And that means they're going to have to get along. They can be mean to each other, that's fine. But in terms of the economic interconnectivity, if they were really to try to decouple, it would be an economic, I think we can say, disaster in China and in the US. And I think both presidents would rather avoid that.
Absolutely. High yield credit?
Selective, I mean, again, diversified portfolios. So neutral, I suppose. It can play a role in portfolios. It does play a role in portfolios. We'd want to be selective, I think, right? So particularly given our view inflation's too high, rates probably can't come down as quickly as some are hoping. We don't want to be too brave in fixed income. We don't want to be too heroic in terms of what's called duration risk or credit risk. So a bit, let's call it neutral, but a bit careful given our frame on where the Fed's going and so forth.
Rare earth metals?
Seems like a long. So very interesting deal done just in the last few days between the US and Australia, where it does feel, again, we're having this, it's a different world. So for much of the last 50 years, there was almost a separation between church and state, where politics and economics were almost perceived to be different things. They're now the same thing. This word that I'm still getting used to of geoeconomics. And I think, as I say, this deal that was done between President Trump and Prime Minister Albanese, very, very interesting. There's lots in it. But one bit, obviously, is America's desire to do more business with Australia. That transcends submarines and rare earths. So it's going to take some time, right? You can't just click your fingers and solve for Chinese dominance in the rare earth supply chain. By the way, it isn't just the earths, it's the processing and so forth. It's the tech around those that is hard to deliver. But no, rare earths are obviously a critical problem for now. And money, I think, is going to have to flow in to create an alternative ecosystem which is more amenable to Western, particularly US power.
And then, of course, considering you're here, the Springbok rugby team.
Sadly, and my best friend is a South African, so this hurts. But I mean, it's just a strategic long, I think, forever, isn't it? So no, you guys are very good. And what I love, I'm a terrible rugby player. Well, I was 100 years ago. And what's so nice is if you come from even rugby playing nations like England and France. There's only like a little bit of England. Southwest England is a rugby culture, but obviously the whole of South Africa is something like a rugby culture. And if you like that, which I do, it's kind of awesome to see, hundreds or thousands of people watching high school rugby, right? It's just fantastic. So yeah, grudgingly, given my chum, hi Ryan, if you're watching, it's obviously a massive long, good for you. Don't talk about the World Cup, but you're pretty good. Yeah.
It's awesome to know that BlackRock is long the South African rugby team. I was absolutely expecting that. Ben, thanks for your time. As the listeners can certainly attest to, I can ask you anything and you have a great answer for that. So we really appreciate your time, your insights. And for those of you at home, we look forward to having one of these sessions again, hopefully with an interesting speaker like Ben again. But thank you for your time. It was fascinating.
My pleasure. Thank you for having me.